On a crisp October morning in 1929, Manhattan seemed calm, almost ordinary. But beneath the polished facades of Wall Street, something invisible and deadly was stirring. A web of speculation, greed, and reckless optimism had been quietly growing for years, and no one realized it was about to collapse. Millions of investors, from wealthy tycoons to middle-class workers, believed the stock market was a golden machine, one that could only go up. Every day, prices soared higher, and confidence reached euphoric levels. Yet, hidden within that frenzy were fragile foundations, inflated stocks, unsecured loans, and a system teetering on the edge of disaster. Then, without warning, the illusion shattered. On October 24th, a day forever remembered as Black Thursday, the unthinkable happened. The market plummeted, and with it, the fortunes and dreams of countless Americans. Panic spread like wildfire as brokers shouted, numbers turned red, and portfolios evaporated. What seemed like solid wealth dissolved into chaos in a matter of hours. But the crash was more than just financial loss. It was a revelation. It exposed the vulnerabilities of capitalism, the dangers of unchecked ambition, and the human tendency to ignore warning signs. Almost a century later, the Wall Street crash of 1929 remains a haunting mystery. How could one of the world's most powerful economies fall so fast? What mistakes were made, and what lessons were overlooked? This is the story of that fateful day when capitalism shook to its core, and the echoes of its tremors are still felt in the markets today. To understand the Wall Street crash of 1929, we must first step back into the roaring 1920s, a decade of unprecedented economic growth and social change in the United States. After the devastation of World War I, America emerged as a global economic power, fueled by industrial expansion, mass production, and technological innovation. Cars, radios, and household appliances became symbols of prosperity, and the stock market seemed like the gateway to endless wealth. Investors of all kinds, bankers, businessmen, and ordinary citizens, were drawn into a speculative frenzy. Stocks were no longer just for the wealthy. The middle class eagerly joined, often buying shares on margin, borrowing money to invest in the hope of quick profits. The concept of buy now, pay later created an illusion of endless upward mobility. The Dow Jones Industrial Average soared, and with each record high, confidence grew, bordering on euphoria. Key figures emerged during this era, both celebrated and controversial. Charles E. Mitchell, president of National City Bank, promoted aggressive lending and encouraged speculation. Meanwhile, financiers like Richard Whitney acted as the public face of stability on the trading floor, often intervening to support the market when prices wavered. Yet, behind these figures, cracks were forming: overvalued stocks, unregulated banks, and a disconnect between Wall Street and the broader economy. The economic boom of the 1920s masked deep structural weaknesses. Agriculture struggled with falling prices, industrial workers faced wage stagnation, and consumer debt was climbing rapidly. While newspapers and society magazines celebrated the wealth of brokers and tycoons, the majority of Americans lived with economic uncertainty. The stock market became both a playground and a trap, a place where fortunes were made overnight but could vanish just as quickly. By the end of the decade, the combination of unchecked speculation, widespread borrowing, and inadequate regulation created a powder keg. The market's meteoric rise had little connection to the real economy. Investors were riding a wave of optimism, blind to the risks. And when the first cracks appeared, there would be no safety net strong enough to prevent disaster. This volatile environment set the stage for one of the most dramatic collapses in financial history, the Wall Street crash that would shake the foundations of capitalism and reverberate across the globe. The story of the Wall Street crash of 1929 begins long before the panic on Black Thursday. Its roots lay in the economic and social transformations of the 1920s. After World War I, the United States experienced a period of rapid industrialization, urbanization, and technological advancement. Automobiles rolled off assembly lines at unprecedented rates, radios filled homes with news and entertainment, and skyscrapers reshaped city skylines. This boom created enormous wealth, but it also fostered a dangerous overconfidence in the stock market. Stocks were no longer just investments for the wealthy elite. Ordinary Americans, eager to participate in the seemingly endless prosperity, began purchasing shares on margin, borrowing up to 90% of the stock's value from banks and brokers. This practice magnified both gains and risks, creating a precarious financial ecosystem. While share prices skyrocketed, much of the rise was fueled by speculation rather than real corporate growth. The mid-1920s saw the Dow Jones Industrial Average climb steadily, reaching record highs year after year. Investors, motivated by the fear of missing out, poured more money into the market, often ignoring the disconnect between stock prices and the actual performance of companies. The mantra of the era seemed to be simple: the market only goes up. Banks and financial institutions, eager to profit, lent money with few safeguards, encouraging reckless behavior. By 1928 and early 1929, warnings began to emerge. Some analysts and cautious investors noted that stock valuations were absurdly high and that the market was increasingly unstable. Yet, these warnings were largely ignored. The dominant mood was optimism bordering on hubris. Brokers continued to promote new investments, and newspapers celebrated soaring stock prices as a sign of national greatness. As summer turned into autumn in 1929, cracks began to show. Trading volumes increased dramatically, signaling growing nervousness among investors. A subtle but critical shift occurred. More and more people started to sell their shares to lock in profits, while others, still blinded by greed, continued buying. This imbalance between selling and buying was the first tremor in a system poised for collapse. By September, the market had reached an all-time high, but the foundations were weakening. The overextension of credit, coupled with excessive speculation and underlying economic weaknesses, created a volatile environment. Investors were perched on a knife's edge, unaware that the slightest shock could trigger a cascade of panic. And that shock was about to come. October 1929 arrived with tension barely noticeable beneath the optimism that still clung to Wall Street. On Monday, October 21st, minor declines in stock prices caused unease among seasoned investors, but the general public remained confident. By Thursday, October 24th, Black Thursday, the cracks erupted into full-blown panic. A record number of shares were sold in a frenzied attempt to salvage profits. Brokers shouted across the trading floor, and piles of unsold stock accumulated as the market spiraled downward. Despite efforts by leading financiers, such as Richard Whitney, who famously bought large blocks of stock to stabilize prices, the selling continued. Confidence shattered, and the illusion of a limitless market vanished almost overnight. By the end of that chaotic Thursday, billions of dollars in paper wealth had evaporated, leaving investors bewildered and financially devastated. The following days intensified the crisis. On Black Monday, October 28th, the market plunged even further, and by Tuesday, October 29th, Black Tuesday, the collapse reached its peak. Stock prices fell dramatically, wiping out individual fortunes and destabilizing banks and businesses. Banks, heavily invested in the market themselves and having lent vast sums to speculators, faced insolvency. Ordinary Americans saw their life savings vanish, and unemployment began to rise as businesses curtailed operations or shut down entirely. The effects rippled quickly across the United States. Families who had invested in the market lost their homes and savings. Businesses failed, unemployment soared, and a sense of despair permeated the nation. The crash revealed the fragile foundations of the American economy. Over-reliance on credit, lack of regulation, and the disconnection between stock prices and real economic growth. Politicians and economists scrambled for solutions, but many of the measures implemented were either too late or ineffective. The Federal Reserve struggled to stabilize the banking system, and public confidence in financial institutions was deeply shaken. The crash of 1929 did not just end the speculative bubble. It triggered a global economic downturn, eventually contributing to the Great Depression. The Wall Street crash serves as a stark reminder of the dangers of unchecked speculation, excessive borrowing, and ignoring early warning signs. What began as a localized financial panic soon transformed into a profound economic and social crisis, the consequences of which would be felt for decades. Almost a century later, the lessons of the 1929 Wall Street crash remain strikingly relevant. Today's financial markets are more complex, interconnected, and technologically advanced, yet some patterns echo the past. Speculation, excessive borrowing, and overconfidence continue to create vulnerabilities that can escalate into global crises. Consider the 2008 financial crisis. Subprime mortgages, derivatives, and risky lending practices created a bubble that, once burst, sent shockwaves through the global economy. Like 1929, millions of individuals lost homes, savings, and jobs, illustrating how financial innovation without adequate oversight can amplify systemic risk. Even in 2025, with high-frequency trading, cryptocurrency markets, and leveraged investments, echoes of the past persist. Rapid gains attract speculative behavior, while over-reliance on credit magnifies potential losses. The key warning remains consistent. When optimism blinds investors to risk and regulation lags behind financial innovation, markets become fragile. Crises do not occur in isolation. They ripple through economies, affecting everyday people. Understanding the Wall Street crash of 1929 is not just a lesson in history. It is a guide to recognizing the warning signs that can prevent, or at least mitigate, the next major financial upheaval. The Wall Street crash of 1929 was more than a financial collapse. It was a powerful lesson in human behavior, risk, and the fragility of economic systems. Unchecked greed, speculation, and overconfidence created a perfect storm that devastated millions and reshaped the global economy. The crash reminds us that prosperity built on illusion is temporary and that vigilance, education, and responsible decision-making are essential. Even today, echoes of 1929 appear in market bubbles, excessive leverage, and blind optimism. By studying history, we can recognize warning signs and understand the consequences of ignoring them. The story of the crash is a cautionary tale. Wealth can vanish as quickly as it appears, and the cost is rarely limited to the elite. If you found this story fascinating, take a moment to subscribe to the channel and hit the notification bell. Join us as we explore the hidden patterns of history and the lessons they hold for today's world, so you can see the future before it arrives.